Hi everyone, welcome to the CA classroom. Today we will be seeing the topic AS5. AS5 says net profit for the period, prior period items and changes in accounting policies. We have one more concept to discuss in this other than what's given here. Now, among all the accounting standards you have, this is the biggest standard in terms of its name, but content wise it's very small. So what all topics do we cover here? First we will see a topic called what is ordinary activity. We will also see the corresponding extraordinary activity. So we will see what is an ordinary activity, how to account for it, what is an extraordinary activity, how to account for it. We will also see what is a prior period item. We will see the definition for that and we will see how to account for it. We will also discuss changes in accounting policies, how to account for it, and we will also see one more concept, changes in accounting estimate. So these are the broad concepts, each are independent concepts. We will just understand what those concepts are and how to account for it. Let us start with definition of ordinary activity. In the previous section we got introduced to AS5. Now let us see the definition of ordinary activities. Throughout the standards, throughout accounting, we keep referring to ordinary activities. What is this? This is the definition of ordinary activities. They are activities that are carried on by the enterprise as part of its business, and all related activities which are carried on in furtherance of or incidental to arising from business. Now let us see what is this. They are activities that are carried on by the business as part. Now let us see what this is. They are activities that are carried on by the enterprise as part of its business. Any sale, purchase, paying employee salaries, all these are part of the business, activities carried on are part of the business. And all related activities. What are activities related to this? Giving discount on sale, getting discount on purchase, increasing employee salary, all related activities which are carried on in furtherance of. What do you mean by this? Let's say company has totally 10,000 employees. Now the company is not performing well, so they have decided to restructure the business. For this restructuring, they have decided to lay off or fire 3,000 employees in 1 year. Now, is this an ordinary activity or an extraordinary activity? The minute I say a company which has 10,000 employees, they are going to lay off totally 30% of its employees, you might think it's an extraordinary activity. No, it is still an ordinary activity. Look at this, and all related activities which are carried on in furtherance of business. That means to continue your business, to ensure your business has a going concern, I have to lay off some employees, and hence this is also an ordinary activity or incidental to or arising from business. For example, sale of scrap. This is also my ordinary activity, incidental arising from business. So almost all your activities are covered under your ordinary activities definition. Now, once you identify an ordinary activity, what should I do? The standard says all ordinary activities which are different in nature, so has different nature, and if it is material, if it is different in nature and is material, has to be separately disclosed in my financial statements. For example, let's say out of my total sales, I have two types of sales. One is export and one is domestic. Hence, both are ordinary activities, but there is difference in nature. One is export sale, one is domestic sale, and both are material in terms of volume, and hence I have to disclose them separately in my financial statements. Out of total sales, how much is export sales and how much is domestic sales. So this is about ordinary activities. Let us proceed to extraordinary. In the previous section, we had discussed about ordinary activities. Now let us see what is an extraordinary activity. Now, the standard defines it as extraordinary activity is an activity which is other than an ordinary activity and it is non-recurring in nature. Example, let us say there is an earthquake and because of this, the company has suffered a loss of 30 lakhs. Now, earthquake is an extraordinary activity. What to disclose in your financial statements? You need to say, current year, I have a loss of 30 lakhs because of an extraordinary activity. Seeing this, the user will know, user of the financial statement will know that out of the total profit, profit has decreased by 30 lakhs only because of an extraordinary activity which is non-recurring in nature, and hence he will understand that this will not happen in the future. Another example, in AS12, you have seen the concept of refund of a government grant. Refund of a government grant is also an extraordinary activities. So most of the activities you come across, 99% are ordinary activities. Very rarely you will come across something which is an extraordinary activity. Now let us proceed to see what is a prior period item. What is a prior period item? The standard defines it as prior period items are income or expenses which arise in the current period as a result of errors or omissions in preparing the financial statements of one or more prior periods. Let us take an example. Let's say in the previous year, the cashier had taken 10,000 rupees and ran away. No, this was not known in the previous year and the financial statements was prepared. In the current year, they had found out that the cashier had stolen 10,000 rupees from the cash box. Now, is this a prior period item for my current year? It says any items of income or expense, this is an expense, which arise in the current period as a result of error or omission. This is not an error or omission. This is a case of fraud by the cashier. So this will not be counted as a prior period item. Let's say rental income of the previous year was 10 lakhs in the ledger. But the accountant, while preparing the financial statements, missed out 1 0 and he had accounted total rental income to be only 1 lakh. Now, current year we have identified that we need to account additionally 9 lakhs as rental income. Now look at the statement. Prior period items are income, rental income, which arise in the current period as a result of error or omission. He made an error and he had omitted to account rental income of 9 lakhs in the previous year, which was purely unintentional error and omission, and hence it will be categorized as a prior period item. The standard says once you classify a prior period item, disclose in your financial statements separately as a prior period income or an expense, because the user should know that this will not recur in the future and it is only a one-off item because of a mistake in the previous years. So this is about prior period items. Let us proceed to accounting estimates. In the previous section, we had discussed about ordinary activities, extraordinary activities and prior period items. Now let us discuss what is an accounting estimate and why do we change an accounting estimate. Accounting estimate is made when reliable measurement cannot be made. Example, provision on bad debts, provision on bad and doubtful debts. Let's say we create a 10% provision on my trade receivables in the current year. Now, I create a 10% provision not randomly. Experts, proper experts, analyzing the information, analyzing the past trends, making a prediction for the future based on available information and the quality of information, they make a provision percentage. Now, why do I make a provision? We know that out of the total receivables, some part will not be received. But do I know exactly what that amount is? No. Hence, I make a provision which is an estimate. You make an estimate only where reliable measurement cannot be made. Now, what is the standard saying? Accounting estimate will be made, but however, it will be consistently changing every year. Why? First, you will make a change because you receive new information. You receive new information. For example, I have found out that the trade receivable, the party to whom I have sold goods, has defaulted to make payments to other parties. Getting this information, I will know that he might default for me also, and hence I will increase the provision. One more reason, change in circumstances. Now, let's say when the provision was made last year, the industry was doing well, the economy was well, the growth rate was well. So you might have kept a lower provision on the bad debts. But however, next year, that is our current year, economy is not doing well, industry as a whole is bad, then you will increase your provision. So, when do you change your accounting estimate? Whenever you obtain new information, and if there is any change in circumstances, you can change your accounting estimate. Whenever you change, you need to disclose what is the impact in current year profits and what might be the impact for future year profits. If you look at it carefully, your entire balance sheet is an estimate. AS2, valuation of inventory is then lower of cost, or NRV. NRV is an estimate. Fixed assets, plant and machinery value, you revalue and you assess a market value. The market value what you assess is an estimate. Valuation of investments, you find the market value for unlisted investments, that is also an estimate. So your entire balance sheet and P&L, there are a lot of estimates you make, and hence it is very important to make your estimate as close as possible to the actuals so that financial statements give a true and fair view. Now let us proceed to the last part of AS5, which is accounting policies. In the previous section, we had discussed about ordinary activities, extraordinary activities, prior period items and accounting estimate. Lastly, let us see what is an accounting policy. We had majorly covered accounting policy in AS1. What is an accounting policy? Definition we had seen it in AS1. Accounting policy refers to specific accounting principles and method of applying those principles adopted by the enterprise in preparation and presentation of financial statements. Then we had also seen when can a company change its accounting policy. There were 2 points there. One was company can change its accounting policy when there is a change in law or change in statute or accounting standard. We had also seen it can change it for better presentation of financial statements. So this was largely covered in AS1. What we are going to see is the impact. Whenever a company changes its accounting policy, what is the impact and what has to be disclosed is given in AS5. It says whenever company changes its accounting policy, disclose the impact on current year profits and also disclose the impact on the future profits. So what will be the impact for current year profits and what will be the impact for future profits? Let's say company changes method of depreciation from SLM to WDV, diminishing balance method. The amount charged to depreciation in straight line method will be same every year. In diminishing balance method, it will be decreasing. So you have to disclose current year because of this how much of my profit has increased, future how much of the profit is going to increase because I have changed my method of depreciation. So AS5 says whenever you change an accounting policy, disclose its impact on the current year and future profits. So this is about AS5. Thank you.